Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Big tech tumbles as the Magnificent Seven enter correction territory. We're going to preview today's hotly anticipated earnings from chip giant Nvidia. Bloomberg learns that Ukraine has signed a deal with the US to develop its natural resources. Meanwhile, President Trump adds copper to his list of possible trade tariffs. Plus, the French finance minister tells us he discussed a Ukraine ceasefire and trade tensions with President Trump. We are live in Cape Town for the G20 finance ministers meeting. Happy Wednesday. So it is a big day when it comes to the earnings story. We're building up, of course, to Nvidia later today, after hours, of course, and that will be the key catalyst for these markets on the earnings front. But before we get there, some lines crossing in the European space. Deutsche Telekom, the owner of T-Mobile, of course, seeing 2025 adjusted EBITDA of about 44.9 billion euros. You can see over a year that stock is up close to 60%. So that's the top line coming through from Deutsche Telekom. We're expecting earnings as well from E.ON and a number of other companies, including Danone later as well. In about 30 minutes time, we'll bring those lines for you. Let's check in on the markets right now, because we talked about the sell-off in technology yesterday, but sentiment is changing in the session, particularly when you look at US futures. Also, Treasuries. That story was pretty dramatic yesterday in terms of the rally across the curve, but particularly around the 10-year. You saw a bit of inversion as well. That story stabilising in the session today. European futures then pointing to a solid start this Wednesday after the losses of yesterday. Currently pointing high by about 0.8%. The FTSE 100 currently looking to add around 62 points. Stateside, after the selling again yesterday, another half a percentage point drop on the S&P, another more than 1% drop for the Nasdaq 100. Currently, futures pointing in a slightly more positive direction. Up 0.4% on the S&P, currently pointing against a 0.6% for the Nasdaq 100 after 4 straight days of losses and about 5% downside over that period of time. But again, the mood looking a little bit more positive as we build up to this Nvidia earnings, of course, later today. Let's flip the board and look cross-asset. You saw an 11 basis point move lower in yields on the benchmark US 10-year yesterday on weaker data, particularly around the consumer in the US. Concerns building, it seems, about potential fragility around the US economy and whether that narrative will be sustained. 432 right now on the benchmark 10-year, with yields moving a little higher. There's a bit more stability in the Treasury markets today. 432. Euro dollar at 104, currently down 0.2% on the single currency. Brent at $73 a barrel, up 0.2. And copper in focus on that executive order from President Trump, scrutinising that metal. Potential tariffs then in the pipeline when it comes to Dr. Copper, currently pointing higher by 0.7%. Let's cross over right now to Singapore. Avril Hong with a check on the Asian market. Avril.
Yeah, Tom, we're seeing Asia markets really getting driven by tech today. It is that caution you're seeing in Japan, Tokyo Electron, the big drag ahead of Nvidia earnings, but also digesting Trump policies, but going the other direction. Chinese tech names, they're soaring today. Highest level since 2021, we're seeing on the Hang Seng Tech, lifting the Hang Seng to the highest level since 2022. Couple of drivers when it comes to the AI narrative in China today. We've got DeepSeek reopening access for core programming interface. This is a key part of wider adoption of its hugely popular AI models. We had reports that these markets regulators have spoken to Alibaba, JD.com, and maybe as they search for views on fair competition, that signals lighter touch when it comes to regulation. Worth noting as well that the Chinese president is said to have spoken to his officials and suggested to keep calm despite the domestic as well as the global challenges. So to some, this suggests a more measured approach in dealing with Trump and his policies, highlighting as well that the yen is reversing from earlier gains. Flip the board. It's really this idea of US-China tech decoupling at play here. And if you look at this chart, if we can just take a look at it, courtesy of MLive's Mark Cranfield, will show you how Alibaba has been outperforming versus Nvidia, the respective AI darlings of the US and China. The thesis of the tech decoupling will really be put to the test with those Nvidia earnings, Tom.
OK, keep calm and carry on. The message from Xi Jinping. Ava Hong in Singapore with a market check on Asia. Thank you very much indeed. Back to the earnings story then, and Redhead crossing the terminal right now because it's a solid beat from the brewer of Budweiser, AB InBev, coming through with fourth quarter organic earnings, EBITDA, adjusted of 10.1%. That was the increase, well above the estimates of 7.95%. The outlook and the guidance for 2025 as well is strong, seeing 2025 organic adjusted earnings of between 4 to 8%. That's the range, 4 to 8%. The estimates had been for around 5.9%. So at the top end of that range, comfortably above the estimates. In terms of the fourth quarter organic revenue, also coming in higher than the estimates, an increase of 3.4%. The estimates had been for an increase of 2.5%. Also looking for the margin story, comfortably stronger as well. 35% is the margin, 35.3% above the estimates. Again, so a strong set of numbers, it seems, for the Budweiser brewer. North American volumes coming in with a contraction of 1.1%. Not a big surprise there, but that is less bad than the estimates in terms of the softness in the North American market. Top line, fourth quarter organic earnings coming in comfortably above the estimates for AB InBev. Let's get back to the geopolitics then. From the earnings story to geopolitics, and Ukraine, of course, still front and centre. Said to have agreed then with the US to jointly develop its natural resources and what may pave the way towards a ceasefire in Russia. Ukrainian President Volodymyr Zelenskiy is planning to travel to the US on Friday to seal the deal.
I hear that he's coming on Friday. Certainly, it's okay with me if he'd like to, and he would like to sign it together with me, and I understand that's a big deal.
Let's bring in Bloomberg's Russia economy and government editor, Greg Sullivan, who's been following all of this for us. Greg, does this move the US closer to that ceasefire deal in Ukraine in terms of its ongoing conversations with Russia?
Well, there's no doubt that this is a key step. A long ways remains. But before this, we had been seeing tensions with Trump and Zelensky boiling over, Trump even labeling Zelensky a dictator. However, this was a very important deal to Trump. He sent his own Treasury Secretary, Scott Bessent, to Kyiv to lay out the initial terms. Of course, there were back and forths, up and downs in the negotiations, with Kyiv even pushing back against that $500 billion fund. But now it does seem that they've reached an agreement on some sort of deal. Now, for the ceasefire, it's going to take two sides to agree to stop the fighting. And for Russia, they've said that they don't want a truce before any final long-term deal is reached. Russia's been making some battlefield gains. They've been costly. They've been slow. But nonetheless, they see it as strengthening their hand at the negotiating table. So Putin is likely calculating that time is on his side. But nonetheless, this does seem to be a step forward, at least between the U.S. and Ukraine. Now, one thing I would caution is that one thing we know is not in the deal are specific security guarantees that Ukraine has sought and are likely to form the sticking point for any ceasefire negotiations.
Well, and that ties us, doesn't it, to the defence spending then in Europe. And the UK Prime Minister coming out with a set-piece announcement yesterday around Britain ramping up its defence spending. I guess there's a couple of questions here. One, will it be enough given that the UK military has been hollowed out over the last decade or so? And the other question is, will others follow in Britain's footsteps?
Those are key questions. And, there's no doubt that this is a broader trend in Europe. Europe has been rushing to come up with a response and with a security framework given recent movements by the Trump administration. I mean, in a lot of ways, this is a response to recent moves from the Trump administration. Earlier this week, we saw them vote with Russia, Belarus, and North Korea on a UN security resolution that would have condemned the Russia's full-scale invasion of Ukraine. Also, we saw the U.S.-Russia contact in Riyadh. That largely left European capitals stunned and sidelined. So now they are trying to run forward with a way to basically keep the dialogue open with Trump. Now, with the UK, we know that Keir Starmer is headed to Washington later this week. Obviously, he's announcing this to try and address one of Trump's biggest criticisms, that's defense spending in Europe. But he's also trying to keep the dialogue open, trying to keep it from Trump from ending the transatlantic alliance. So definitely a pattern, definitely coming in response to recent Trump administration moves that have Europe quite worried.
Yeah, and arguably one of the most significant weeks when it comes to foreign policy for the UK Prime Minister. And we will watch that meeting, of course. Greg Sullivan, Bloomberg's Russia economy and government editor, thank you. Now, recent softening of US economic data suggests the Fed may need to cut rates this year, with traders pricing in two 25 basis point cuts for the remainder of 2025, up from between 1 to 2. There was some indecision there. For more on this, let's bring in Bloomberg's Valerie Teitel, of course, always has the finger on the pulse of the markets. And there's volatility back in these bond markets, Valerie.
The volatility in the Treasury market yesterday catching many by surprise. Tom, it's very interesting to see that now we are reacting not to the inflation concerns around tariffs, but we're reacting to the growth scares that tariffs could entail. We saw a stark rally in the Treasury market yesterday. Yields are now around their year-to-date lows. The 10-year yield is now 50 basis points lower than its high seen in January last month. A lot of this has been added fuel to the fire. That consumer confidence data yesterday coming in surprisingly weak. We flip on, we can check about this string of weak economic data that has hit the U.S. economy. The first one being that retail sales miss, the biggest miss in 2 years. PMI services downside surprise, UMISH sentiment, those Walmart earnings with that profit warning from Walmart, and then yesterday's consumer confidence adding to this string of economic worries. We're really trading this growth scare narrative yesterday. Equities were weak. Oil fell as well. But on that equity story, we were really on a shaky footing ahead of this big earnings release out of Nvidia coming tonight after the bell. S&P 500 is hit a 5-week low yesterday, taking its 5-day losses to nearly 3%. And the losses in tech are worse. NASDAQ 100 down some 4% in the last 4 sessions. And that Mag 7 index sliding into correction territory, Tom, now 10% down from its December highs.
Yeah, Val, as you say, look, it just puts more scrutiny on those Nvidia numbers, doesn't it? Bloomberg's Valerie Teitel, thank you very much indeed. Angst around the US economy. Didn't think we'd be saying that a couple of months ago, did we? Let's get to the Nvidia story and then a preview. It's the last, of course, of the Mag 7 stocks to report, and one of the most keenly awaited, as Val was saying. Nvidia's fourth quarter earnings later today will be scoured for signs of how AI spending is holding up, of course, with big tech stocks in retreat. Bloomberg Intelligence Technology senior analyst Masahiro Wakasugi has more. Masahiro, what are some of the key metrics then to watch for from these Nvidia earnings out later today?
Okay. Regarding Nvidia earnings, the most important key metrics would be the revenue for the January quarter just finished, and the consensus number is around $38 billion US dollars. And if we look at the April quarter guidance, maybe the consensus is around $42 billion US dollars. So that two numbers should be quite important. And over the past few quarters, Nvidia increased its revenue by around $4 billion US dollars every quarter. So we can say that AI workload, which is equivalent to the $4 billion US dollar, increased over the past few quarters. So if we see the same pace of the growth for the revenue for Nvidia, we can say that the AI workload should be increasing smoothly. And also, we would like to hear some news or maybe information about the Blackwell ramp-up schedule. So we hear that a little bit of delay in later last year. But if we can hear some good progress for the Blackwell, that should be relieving news. And also, Nvidia may touch some part on the next generation Rubin platform for the next generation GPU. So we'd like to see if they are on track to launch new GPU going forward. So that would be the major key points for the Nvidia earnings tomorrow.
Okay. That's a nice preview. Thank you very much indeed. Bloomberg Intelligence Technology senior analyst Masahiro Wakasugi on what to watch for from those key Nvidia earnings. A story, of course, we will be across in detail. Thank you. Coming up, Chinese stocks soar. So it is pressure, of course, on their US counterparts. But over in China, tech stocks soaring on AI optimism, rebounding after a sell-off, while the Mag 7, as you can see on the wall right now, enter correction territory, though NASDAQ 100 futures are pointing to decent gains so far in the session. We're going to speak to Winnie, Chief China Equity Strategist of Bank of America Securities, on how to think about the AI innovation in China and how to position in that market. That's coming up. This is Bloomberg. Welcome back. Chinese President Xi Jinping has urged officials to stay calm and composed amid domestic and global challenges. A sign, perhaps, that Beijing will take a measured approach to the Trump administration's new trade and investment restrictions. At a time, of course, where we're seeing another strong rally for tech stocks listed in Hong Kong. Chinese tech stocks, of course. For more on Chinese markets, let's bring in Winnie Wu, Chief China Equity Strategist of Bank of America Securities. Winnie, we start with a question about two pretty clear tensions. One is the geopolitical overhang when it comes to Chinese equities, and the other is the AI catalyst. How are you thinking about those two factors when you're just talking to clients about their exposure to Chinese stocks?
Yeah, absolutely. So those are the two factors. Actually, it's not within the control, not completely within the control of Chinese government. And it's probably the areas where investors have very low visibility of. One is whether Chinese stocks remain investable given the escalating geopolitical tensions. And second is there a long-term growth story for China overall and for the major Chinese tech stocks? But I think the sentiment in the past months improved, right, in terms of the geopolitical tensions. Seems after Trump's inauguration, a lot of the focus were not particularly on China, at least for now. And people are still waiting for the meeting between President Xi and President Trump. And hopefully there's some sort of agreement or deal that will be formed that can help ease or stabilize the geopolitical tension there. Also, on the technology front, I think, the DeepSeek, the breakthrough, is really encouraging. It shows the potential of China in terms of in that continued development, innovation, and competitiveness in the AI era.
And Winnie, it's interesting on DeepSeek. You describe it not so much as a Sputnik moment, which is what Andreessen Horowitz described it as, but you describe it more as the kind of the Alibaba IPO moment. Just explain that for us. That takes us back to 2015.
Right. So, I think there are two sides of the story. In terms of the long term, potentially, I think this is similar to Baba's IPO moment in end of 2014, which is very important in terms of inspiring innovation and reignite the animal spirit. If you look at 10 years ago, Baba was listed in September 2014. PDD, one of the biggest e-commerce company in China now, was only established in 2015, and TikTok wasn't launched until 2017. So with the success of DeepSeek, hopefully it can help turn around, the morale, the sentiment in China, which is in the past 2 years, almost every segment in China, ranging from local government to SOEs to the private companies, every segment in the past couple of years in China were very much in the de-risking, de-leveraging, risk-off morale and mentality. Hopefully with DeepSeek, people see the hope, people see the inspiration, and more companies, local government, and entrepreneurs will be willing to invest, to innovate. So that's very important for a long-term growth driver, innovation, competitiveness for China. But on the other side, the short-term implication is also that despite Baba IPO in September 2014 and the strong China market rally in early 2015, market had another big correction in mid-2015 and didn't bottom until 2016 because the fundamental hasn't catch up yet. The economy, the deflation problem 10 years ago took time to resolve. So currently for the short-term market rally, again, market like to overshoot, market want to see this bullish optimism goes on. But when it comes to a lot of the underlying earnings, GDP, employment, deflationary problem, it will probably take a few more quarters.
The National People's Congress is coming up, a major event, of course, in terms of the two sessions and policy agenda for the government in Beijing. Winnie, what are you going to be looking for that can sustain the momentum in these markets?
Yeah. I think the good news is currently investor expectations are not very high. People said that this rally is not driven by policy stimulus expectations. So, even if NPC come up as a non-event, it might not derail the rally. For the key things people are looking for, I guess, very high level. One is the fiscal policy, because that's really the thing we've been calling for, that, monetary policy has become less effective. Importantly, fiscal policy need to be more proactive proactive. So the budget deficit this year as percent of GDP is probably one key thing. And then besides that, the second thing is really policies to support consumption, domestic consumption, private sector, jobs, new births. Right, because these are areas, with or without tariff, China's facing a demographic challenge. So subsidizing and supporting new births should be a policy that can be launched regardless of these tariffs or geopolitical tensions. Similarly, private sector youth and employment, private sector confidence remains to be challenges. So these are still very important policy for the government to launch more.
OK, fiscal stimulus and more support for the consumer is what could be on the agenda at the National People's Congress. Meanwhile, the HS Tech Index up around 5% so far in the session. So another very strong day for Chinese tech. Winnie Wu, Chief China Equity Strategist at Bank of America Securities, thank you. Coming up, the EU set to unveil some key components of its efforts to tackle the bloc's lacklustre competitiveness. We're going to discuss the details next. This is Bloomberg. European Commission President Ursula von der Leyen will meet with industry leaders later today to discuss boosting competitiveness during an ambitious green overhaul. Drafts of the Clean Industrial Deal, seen by Bloomberg, shows the bloc is planning simpler state aid rules in a bid to boost clean tech investments. For more on this, let's bring in Bloomberg's Oliver Crook, standing by for us in Berlin. Ollie, walk through what is planned then with this industrial strategy.
Yeah, so listen, Tom, we should get the sort of details, the official details of this in about 3 hours' time. It's going to be unveiled. And this is going to be sort of a number of different things that will be all unveiled at once and really putting the urgency of competitiveness at Europe at the front and center. This is really kind of the first step in the big legislation from this new commission and basically how to do that. This will include, Tom, both a bit of stick and a bit of carrot, right? Where on the one hand, there's the Industrial Clean Deal. This is basically the Green Deal 2.0 that basically has been kind of revamped after the sort of detractors from the sort of climate agenda have sort of got their influence in and saying that basically competitiveness is more important. What this will basically include is this carrot side of things of slightly looser state aid rules, being able to do more tax incentives in order to boost sort of clean tech, but also sort of industries. On the other side, they also want to roll back a lot of this stick, some of the regulations, right? The EU does not want to call this deregulation. They want to call this simplification. But basically what this amounts to is going to be making it a little bit easier for companies to basically reduce the burden of all the reporting they need to do, all the audits they need to do on their supply chain. And let's not lose sight of the fact that this was also going to be a much larger scope in terms of the number of companies that this included. Basically, they want to roll this back to not touch some of the SMEs, basically rolling it back to touch about basically 85% fewer of the companies that they were originally going to target. This all comes into focus, Tom. Remember, the Draghi report was written when basically just the sort of concerns about China were predominant. That was written in September. Since then, the election of Donald Trump, the EU has really lit the fire in understanding that their competition is not just against China, it's also against the United States. And as the United States aggressively deregulates, that is something that in Europe they basically cannot ignore, where basically their industry is structurally less competitive. They feel that adding more regulation to that is just adding more hurdles to that already sort of grim picture.
OK, and this is the response, and we'll see, of course, how industry responds to this plan. Bloomberg's Oliver Crook in Berlin with the details and the preview. Thank you. Coming up at the world's finance ministers descend, or as the world's finance ministers descend on Cape Town, we're going to get the latest on how the G20 is responding to those tariff threats from President Trump. That is next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Big tech tumbles as the Magnificent Seven enter correction territory. We're going to preview today's hotly anticipated earnings from chip giant Nvidia. Bloomberg learns Ukraine has signed a deal with the US to develop its natural resources. Meanwhile, President Trump adds copper to his list of possible trade tariffs. Plus, the French finance minister tells us he discussed Ukraine and a ceasefire and trade tensions with President Trump. We are live in Cape Town for the G20 finance ministers meeting. We'll check in on these earnings because the story is turning more positive since the sell-off yesterday. Nasdaq futures currently pointing to gains. Across the earnings story, though, lines crossing Munich Re, the insurer, of course, and we're going to be speaking to executives in the next hour or so from this company. Munich Re, by the way, the stock is up about 8% year to date. Here's the dividend per share coming in above the estimates of 20 euros. That is the full year dividend per share for Munich Re, above the estimates of 16.5. In terms of the guidance around 2025, they see reinsurance profits of 5.1 billion euros. It's a beat in terms of the 2024 profit goal from Munich Re, and they plan 4.6 billion euros in payouts. So in terms of dividends and buybacks, the profit for the fourth quarter coming in at 979 million euros. They see 2025 insurance revenue of 64 billion euros, roughly in line with the estimates. We're watching, of course, for Stellantis as well, and we'll get those and bring those to you when we get them. Danone is next up in terms of the earnings story. Like-for-like sales seeing an increase of 4.7%. That's the promo, by the way, for the CFO of Munich Re, who we're going to be speaking to later. To Danone, of course, the dairy and yogurt producer, like-for-like sales in the fourth quarter increasing 4.7%. The estimates had been for an increase of 4.2%, so it's a beat in terms of like-for-like sales in the fourth quarter. Sales coming in at 6.7 billion euros. That's a beat on the estimates. Dividend per share for Danone full year also slightly above the estimates. So a beat for Danone on the top lines, and that stock, by the way, is currently up about 7% year to date. We're going to be speaking to the Deputy CEO of Danone, Jürgen Esser, exclusively at 8:40 a.m. UK time. Let's get to the broader market story right now, because, of course, the sell-off that we saw yesterday in the US starting to reverse as you look at those futures. But you did see 4 straight days of declines for the Nasdaq 100, with losses around 5% over that period. The Nasdaq 100 fell 1.2% yesterday. The S&P dropped 0.5%. But the sentiment is turning. Nvidia could be the make or break story for these markets, at least in terms of the short term. European stock futures pointing to gains of 0.7%. FTSE 100 futures pointing up by 63 points. S&P futures, after the losses that we've seen over the last few days, pointing higher by 0.4%, and Nasdaq 100 futures looking to add 117 points, making up for some, but certainly not all, of the losses that we've seen in the last 4 sessions. Let's flip the board and look cross-asset. You saw a big rally across the Treasury curve yesterday. Yields falling 11 basis points on the benchmark 10-year. That story is moderated in the session today. 432, the weakness around some of the economic data out of the US causing concerns about US exceptionalism and whether that story is starting to crumble. Yields up 3 basis points in the session. 104 currently on the single currency. The euro down 0.2%. Brent up 0.3%. And copper, with that executive order from the Trump administration in focus, potential tariffs for that metal, currently gaining 0.6%. Now to the G20, where finance ministers and central bank governors, of course, are gathering at that meeting in Cape Town. The group are increasingly under pressure from the actions, of course, of the US president, who has whipsawed financial markets with tariff threats on an almost daily basis since returning to the White House last month. French Finance Minister Eric Lombard spoke exclusively to Bloomberg about his meeting with the US Treasury Secretary Scott Bessent.
We discussed all the issues: trade, tax, non-tariff barriers. We agreed to continue to talk, which is a step forward. We met for the first time. We met on a one-on-one meeting, and also, of course, Secretary Bessent participated to the meeting with the 2 heads of state, President Trump and President Macron. We'll meet again with the IMF meetings in Washington in April. We exchange sell numbers. And so we will discuss within OECD as far as taxes are concerned, and at the European Commission level for trade.
For more, let's bring in Jen Zabasaja, our chief Africa correspondent in Cape Town, joining us now, who had that conversation, of course, with the French finance minister. Jen, what can we expect then from the South African president, Cyril Ramaphosa, when he speaks later today at the G20?
Right, Tom. We actually just saw the president entering in here into the building. So the expectation is we'll hear from him quite soon. And really, we think that it's going to be a continuation of some of the messaging that we heard from him last week, which is pushing for unity amidst all of these conflicting challenges that we're seeing globally, and using the G20 as a response and a coordinated response to address some of these challenges. But as you've been talking about, and we talk about day in, day out on the show, you take a look at the combination of members that make up the G20 and the issues that they're being dealt with. And there's still a lot of division in terms of how to handle each one. And we even heard that from South Africa's Ronald Lamola, who said the geoeconomic tensions from trade, from sanctions, and all else are making it very difficult to find some union. But the expectation, though, is that we will hear from President Ramaphosa continuing on this theme of solidarity, equality, and sustainability. The big question mark, though, is how do we see a lot of these leaders coming together and finding unity when some of the biggest leaders and countries are not here? Namely, I mean the U.S. Treasury Secretary Scott Bessent is not going to be present at these meetings today. You just heard there from the French finance minister who returned from Washington meeting with Bessent. The U.S. will be represented by senior leaders, but still, how much can actually get done, and what does the future of the U.S. in particular within these blocs look like? But President Ramaphosa expecting to say that hopefully we will see some unity in terms of some of his most pressing issues. And he talks a lot about climate finance in particular. So how can these countries come together and address some of the inequalities that we've seen as far as what developing countries have been through versus developed countries? And there's also the debt burden. How can some of these members work together to ease some of the debt burdens that a lot of the global south and Africa more broadly are dealing with? So that is the expectation. We're waiting for him to speak, hopefully in the next few minutes, Tom.
OK, Bloomberg's Jennifer Tapasoja on the ground for us at the G20 as we wait for that speech, of course, by the South African president, covering all of that action at the G20 for us. We're going to have a great lineup as well of additional guests at that finance and central bank governors meeting. We're going to speak to the German finance minister and Eurogroup president in the next few hours. Spain's economy minister and the CEO of 91 Capital will join us tomorrow. Now, Bundesbank President Joachim Nagel says that having a, quote, robust, stable government in Germany is important, and one of the first priorities should be economic growth.
In days where there are so many uncertainties, and we discussed some of these uncertainties, it is very important to have a robust, stable government with priorities. And one of these priorities definitely should be what we could do better when it comes to the growth perspective for Germany, how to boost economic growth.
OK, the central bank governor, of course, of Germany, speaking there after the election results. Let's bring in at this point for a view on these markets in Germany. Sabrina Reeh, German equities portfolio manager at DWS. Sabrina, thank you for your time. What assumptions are you and the team making right now about the speed and pace at which a coalition can be formed between the CDU, CSU and the SPD in Germany?
So thank you for having me. First of all, I would say that the outcome of the federal election was a positive one in our assumptions, and the pace we expect would be that around Easter time the government is formed. I think the Chancellor Friedrich Merz is very aware of the fact that it is of high urgency to be at a fast pace, and that the top priority should be also implementing key discussion points that are important to boost the economic growth in the country.
I wonder, Sabrina, how short-lived the optimism in the markets will be about this potential stability, given the challenges around one key factor, which is loosening that debt brake in Germany, the need for two-thirds majority in the Bundestag, which seems a challenge at this point, given the political arithmetic. If we do not get a loosening of that debt brake in Germany, does that constrain further upside for German equities?
So I think you're right, obviously, in saying that we've already seen high optimism in terms of heading into the election. The DAX is up in the 2-digit range year to date, and also this end of the year was quite strong. The DAX has outperformed the US markets, but also the Euro stocks so far. So it's just had a strong run. So it would be okay to see a breather here for a short time. But I would say that one of the key points to address is the loosening of the debt brake, and we've heard discussions on this, and even if the debt brake isn't loosened entirely and something like an off balance sheet fund, for instance, is made for this, so that investments can be made for infrastructure spending, defense spending, that would also be an option, and that is something that is being discussed. So I would say that there are possibilities to maneuver around the 2/3 that is required. And also there's obviously discussions right now whether the government can implement the loosening of the debt brake with the former government already. That would be a possibility. And so I would say there's two scenarios, either with the former government or by having an off-fund kind of situation.
Under those scenarios then, Sabrina, what is your expectation around, or at least your preference in terms of exposure, whether it's to the mid-caps that, of course, have underperformed the DAX, given the very strong performance of the DAX, or if you want to kind of take shelter in some of those bigger names in this environment, given some of the uncertainties? What is your preference on an index level?
I mean, I think we've seen after the election there was a bit of a higher increase in the MDAX versus the DAX because there is just a bit more of a correlation for the MDAX names versus the DAX names to the local economy. So we have roughly 30% of earnings that are generated with the MDAX companies within Germany, and only 20% for the DAX names. The DAX names have had a run, but I would say that there is a possibility that actually the performance in the German equities market spreads into breadth. So last year we saw in the DAX names that actually we also had Magnificent Seven. So this was the performance was boosted by a few select names, and this could broaden out with further sentiment improving in Germany. But the MDAX names would definitely have a higher, I would say, boost because valuation levels have been depressed. They've underperformed over the last 3 years versus the large cap names. So I would say the higher potential is there for the mid cap names, but I think it very much depends on what the government really decides on how to boost the local economy and how quickly that is done. But I would say the leverage for the mid-cap names is higher from the current standpoint.
OK, so there's some leverage there, but if things align in terms of supportive growth environment and maybe some adjustments to the debt brake, that could be how to position. Sabrina Reeh, excellent analysis across these German markets. German Equities Portfolio Manager at DWS. We'll have to get you back to talk about the tariff impact as well, because we've run out of time this morning. But thank you. Coming up, after Bloomberg learns that AI startup Anthropic is nearing a fundraising deal at a valuation above $60 billion. Can Europe boost its own AI sector? That is next. But as we head to break, we're going to bring you pictures right now. The South African president speaking live. Cyril Ramaphosa addressing the G20. Let's listen in briefly.
Of the G20 Sherpa track for 2025. The meeting of foreign ministers reaffirmed the important role that is played by the G20 as the premier forum for international economic cooperation. I was very heartened to hear that confirmation. It is underscored by the fact that there is collective responsibility of the G20 for the effective stewardship of the global economy. It also has to foster the conditions for sustainable, resilient, and inclusive global growth as a critical element of the broader multilateral system.
Welcome back. Bloomberg has learned that Anthropic is close to a deal to raise $3.5 billion at a valuation of $61.5 billion. So it's a reminder of the ability, of course, for some of those big foundation model companies and startups in the US to raise capital. What about Europe then? What can Europe learn from these big check valuations, and where should the EU and EU countries invest in AI. I'm joined now, very pleased to say, by the Managing Director and Head of Europe of General Catalyst, Jeannette Fürstenberg, for some analysis on this. And this is something you've been thinking deeply about, Jeannette, not just for the last week or so, I know, but for a number of years. Talk to us about what you and General Catalyst, along with another slew of big names in the corporate space and in the VC space, have launched, which is the EU AI Champions Initiative. What is the ambition? What is the goal? What are we going to see implemented as a result of this initiative that will boost the competitiveness of Europe?
Yes, Tom, it's wonderful to see you. The EU AI Champions Initiative really is a great example and a proof of Europe's competitiveness in technology and in AI. And I think it has really created remarkable momentum. We now have over 80 companies signed up, and these are some of the largest names across Europe. And we actually have over 450 organizations that have expressed interest in joining since. And I think the interesting part about this one really is that it's for the first time that innovators and adopters of AI are coming together to really frame an ambition. And I think the interesting thing with AI right now, Tom, is while we see all these big announcements, we really still live in peak ambiguity. There isn't yet clarity as to where long-term value creation will accrue. And so we believe that will very much lie in the application layer of AI.
What level, that's interesting in terms of peak ambiguity, Jeannette, what level of adoption are you seeing at the coalface in terms of enterprise adoption?
Well, it's interesting. I think so far enterprise customers have primarily tried to build first sort of proof points. They try to, experiment on top of AI. They kind of have put stuff in sandboxes, but they haven't really pushed a lot into production yet. So I think a lot of the production that is currently happening is happening in horizontal enterprise workflow levels. The interesting part will happen once we actually go into the vertical depths of many of the sectors we're seeing in Europe. And once we're seeing AI really unlock the value that sits within the distribution and also the data advantage that these companies behold. So I think the hope here really is that Europe has a huge chance in really 3-4xing the market cap of many of our global world market leaders by really leaning into AI for like an increase in profitability and also productivity going forward.
And Jeannette, I know you have conversations with EU commissions and those in Brussels. What is your conviction, Jeannette, that the European Union is taking this seriously and is willing to actually act on some of these initiatives?
Yeah, well, Tom, this is the first time that I think the largest group of European companies and innovators and adopters have come together to work and engage in a process with Brussels. There's a lot of openness at their end to understand what we are, what we're asking for. I think from a Brussels sort of point of view, it's sometimes hard to grasp where the conflict lies between vertical specific regulation, for example, the banking industry, as well as the more horizontal regulations such as data governance, as well as the AI Act. And a lot of times that leads to unintended consequences, which blocks certain industries from using AI and really leaning into it. Bird, I don't know if you followed, which is a Dutch cloud startup, actually announced that it would be leaving Europe soon. And I think we need to kind of really increase the pressure on Brussels. And there's a lot of openness at their end to engage in a process with this group.
OK, that pressure needs to be increased. When it comes to defence spending, a lot of news in the headlines in the last few days and weeks, of course, Jeannette, given what's changing around Ukraine. Does there need to be greater allocation of funding around defence to the non-prime players, so the non-incumbents, so companies like Helsing, software and defence companies, also in the hardware space now, that you back?
Yeah. Well, listen, I think funding is generally there. If you see the best companies that actually get funding, I think where we really need a shift in mindset, especially, and that is a call to action for the new incoming government, is we need the state as an anchor customer. They need to lean into programs that really involve AI and tech first companies, because these are going to be the defining capabilities that will kind of define defense and deterrence going forward. And as such, I think programs need to change, and we need a fast procurement currently sort of really activated around key sectors such as space defense, and air shield, as well as sort of critical infrastructure that leads to, protection of anything that lies in cables under the ground or under the sea. And so a lot of that will come down to AI-enabled capabilities, and that's where we need the state really to step up its game and act in terms of new procurement and fast procurement capabilities.
Jeannette, just in terms of thinking about the European Union, 27 nations, is the EU structure ill-suited to an innovation that is developing at a pace unlike which we have seen in decades, potentially centuries?
I don't think so. I think we've actually historically always had a very strong innovation ecosystem. Innovation has never been our weakness. We've actually, think of the best AI talent. It's been born and bred in Europe. Jan LeCun, Geoffrey Hinton. These are Europeans. So the talent base is incredibly strong. The innovation base is incredibly strong. It's just that in prior technology waves, we haven't been able to really capitalize on these technologies in the same way. Our market was too fragmented. It was hard for us to commercialize on top of the innovation that exists here. AI is different. And I think it's really important that Europe snaps out of this defeatist mindset where as soon as, the US announces Stargate, we believe we've lost the game. I don't think it's the case at all. I think that we actually very much have an advantage this time around because AI really inherently is transformative, meaning it really leans into the advantages that exist with existing distribution, existing data. So I think there's a lot of opportunity for us.
Okay, a clarion call there to lean into this technology and not be defeatist. 100%. General Catalyst Managing Director Jeannette Fürstenberg, thank you very much. There's plenty more coming up. Stay with us. This is Bloomberg. Welcome back. Well, the Mag 7 has been part of the pain trade in recent days, but will that change with the Nvidia results coming through in now correction territory, the Mag 7? But the make or break moment for the market, at least in the short term, could be those Nvidia earnings. Let's split the board and have a look. Dan Ives of Wedbush saying he expects a solid set of numbers from this company. We're going to be watching the transition to the Blackwell. This is the potential volatility around the earnings story for Nvidia, potential upside or downside of implied volatility of around 9.9% is the implied one-day move after those earnings. This is the earnings story, of course, of the week. Stay with us. We'll give you a preview through the opening trade, which is up next. This is Bloomberg.